This is the solution for problem 7-1A. It's on page 346 of your textbook. They're asking you to use a perpetual inventory system and FIFO. FIFO is the first in, first out. So with each sale, you look to the oldest inventory to sell first. So let's work through the problem. On March the 1st, we started out with an inventory of 300 units that cost $20 a piece, which is $6,000. Notice that's entered under the inventory section. On March the 10th, we purchased 500 units at $21 for a total of $10,500. That's entered in the purchases section. And then we need to update the inventory. We still have the original 300 units that cost $20 a piece, and now we have another 500 units that cost $21. And then on March the 28th, we sold 400 units. Now ignore the $35 a unit that they're giving you in the problem. That's what we sold the units for. What we're concerned with on this schedule is the cost of those 400 units that we sold. So if you look in your inventory, you've got 300 units and then you've got 500. So under FIFO, the first ones in, or the oldest ones, are the ones we're assuming we sell first. So our first sale is going to be the original 300 units that cost $20. But we sold a total of 400 units, so then we would get the other 100 units out of the 500 that cost $21. And that leaves us with a balance of 400 of the 500 units that cost $21. And then on March the 30th, we sold another 250 units. Those 250 units would come out of the 400 that we have on hand that cost $21, and so 400 minus the 250 sold leaves us 150 units. And then on April the 5th, we sold another 80 units. Those would come out of the 150, and those cost $21 a piece. And that leaves us, out of the 150, if we sold 80, that leaves us 70 on hand that cost $21. On April the 10th, we bought 450 units at $22 a piece. So now we have the 70 that we had before at $21, and now another 450 at $22. On your inventory balances, you need to make sure and keep the units in order. Like, you need to list the 70 units at 21 first, and then the 450 that we just bought at 22. And now on April the 16th, we're selling 250 units. Again, using FIFO, the oldest units are sold first. So first, we're going to sell the 70 that cost $21. And remember, we sold a total of 250, so the other 180 that we sold, we got out of the 450 that cost $22, and our new balance is 270. That's the 450 minus the 180 that we sold, leaves us 270 at $22. April 28th, we sold another 150. Those would come out of the 270 that cost $22, and that leaves us with 120 at $22. May the 5th, we purchased 175 at $24, so now we've got 120 at $22 and 175 at $24. And on May the 14th, we're selling 160. Again, under FIFO, you go back to the oldest units, so go back to the 120 and sell those at a cost of $22. Just one second. Okay, sorry about that. So let's see, back to May the 5th, we had purchased 175, so that gave us 120 at 22 and 175 at 24. May 14th, we sold 160. So we would go back and assume we sold the oldest ones first, the 120 that cost 22, and then we would get the other 40 out of the 175 that cost 24. So if we sold 40 out of the 175, our new balance now is 135 units at 24. Then we purchased on May the 25th 150 at 25, so now we've got 135 at 24 and another 150 at 25. Finally, on May the 30th, we sold 140 units. You would go back to our oldest purchase first, so we would assume we sold the 135 at $24, and then you would get the other 5 that are sold out of the 150 at 25. Our final balance then, out of the 150, we sold 5, so that leaves us 145 at $25. Later on, they're going to ask you for cost of goods sold. To calculate that, under the cost of goods sold section, you would add up the total cost column, and that totals $30,725. They're also going to ask you for the ending inventory. You get that from the final balance. So notice on May 30th, our inventory consists of 145 units at $25, which is $3,625. Part 2 asks you to record sales. To do that, you debit accounts receivable and credit sales, and to get that number, $59,450, you would go back to the problem, and every time you had a sale, you would multiply it by the selling price and then add all those up. So you're adding up the sale from March the 28th, which totaled $14,000, March the 30th, $10,000, April 5th, $3,200, April 16th, $10,500, April 28th, $6,750, May 14th, $6,000, and May 30th, $7,000. So if you add all that up, you get $59,450. It assumes the sale is on account, so debit accounts receivable and credit sales. Also recording the cost of goods sold, debit cost of merchandise sold and credit inventory for the total of that column from your schedule, $30,725. Part 3 wanted to know the gross profit, so you take your sales minus cost of goods sold, and that gives you a gross profit of $28,725. Part 4 asked for the ending inventory. That was the 145 units at $25, $3,625. And then they ask you, would you expect the inventory to be higher or lower under the FIFO method versus the LIFO method, which we'll look at in just a minute. And the answer is, since prices rose from $20 from the beginning inventory to $25 from the last purchase, you would expect that under LIFO the inventory would be lower. Okay, let's look at problem 2A, and I'm not going to do the whole problem, but I'll do just enough to get you started. This is, it's the same data, but it's using LIFO, where the last units in are the first ones out, first ones sold. So again, March 1st, we've got 300 units that cost $20 a piece, and we bought another 500 that cost $21. So now our balance is 300 units at $20 and 500 units at $21, and on March the 28th we're going to sell 400 units. So the 400 would have to either come out of the 300 at $20 or the 500 at $21. Under LIFO, the last one's in, or the last purchase that you made, is the first assumed sold. So we're going to sell the 400 out of the 500 that cost $21. Your balance now, you've still got the 320, and then out of the 500 you have 100 left at 21. And then on March the 30th we're going to sell 250 units. Again, under LIFO we're going to sell the last ones first, so we're going to sell the 100 at 21, and then you would get the other 150 out of the 300 that cost 20, and that leaves you with 150 out of the 300 that cost 20. And then we sold 80, so that 80 comes out of the 150 at $20, and that leaves us with 70 at $20. April 10th, we bought another 450 units at 22, so now we have 70 at $20 and 450 at 22. And on April 16th, we're selling 250 units. Those are going to come out of the most recent purchase, so they're going to come out of the 450 that cost 22, and we're left with the 70 at 20, and then of the 450, we sold 250, so we're left with 200 at 22. And then on April the 28th, we sold another 150 units. Those would come out of the most recent purchase, which is the 200 at 22. So the 150 cost 22, and we're left with 70 at 20, and then 50 of the 200 at 22. So hopefully that's enough for you to be able to follow the LIFO method and see that the last units that are purchased are the first units that go out. If you need any additional clarification, you can email me and I'll be glad to get back with you. Your homework that was originally due for tonight has been postponed, and it's due tomorrow night, so that'll give you time to watch this video before you have to turn your homework in.